and resources that are being spent on, saying, the opening ceremonies of Olympic Games, and you go back and you look, okay, and they become more and more spectacular over time. And vast amounts of money and so on are put into just creating this spectacle. And of course, the interesting thing about nearly every city that's ever run these things is they go bankrupt afterwards. Los Angeles didn't, but it's no accident that Greece has gone bankrupt, actually. I mean, the Athens spectacle and the Athens Olympic Games was supposed to have helped Greece immensely. It didn't help it at all. And so, if you like, the consumerism and the spectacle are going together. So, social life and political life and daily life has been changing dramatically, partly in response to the need to accelerate turnover times, not only in production, but to accelerate turnover times in the world of consumption. Now, what I said earlier was that capital moves things around temporarily from one kind of crisis to another. The way I look at the situation today is very much impacted by the way in which I interpret the crisis of the late 1960s, early 1970s. The big crisis was really, global crisis was the 1970s. What was the problem then? The problem, fundamental problem, as I define it, is that labour was too powerful. And labour was well organised, and labour markets were largely confined to nation-state configurations within a world system in which each nation-state was in charge of its own fiscal and monetary policy. And what that meant was that social democratic parties, socialist parties, could push for political power, and they could use that political power to gain in the social wage as well as the kind of real wage, So labour was getting more and more powerful in the 1960s, 1970s within that framework of nation-states which were fairly confined. Now, as we went through the 1960s, there were various attempts to solve that problem from the standpoint of capital. One of the big attempts was to loosen up immigration. And it's a bit astonishing now, given all the way we find ourselves looking at the immigration problem through the public, public perceptions. What we look at is sort of well, these immigrants are a problem. But back then, you find the French government was actually subsidizing the import of Maghrebian labor. The Germans were bringing in the guest workers from Turkey. The Swedes were bringing in people from Yugoslavia and Portugal and all the rest of it. And the British were drawing on their empire. And of course, in this country, in 1965, you had this very far-reaching sort of rewriting of immigration law, which allowed US access to the world global labor reserves. Now, that didn't work too well, so you had to do something else. And so you get this crisis of the 1970s, which arises out of the fact that it looks like, what sometimes the Marxists like to call a profit squeeze. Labour was getting too much of the pie. And not only was it getting it, was also getting politically powerful. And the capitalist class decided to try and break the power of labour because, so there was, if you like, a campaign that developed in the 1970s to do that. Now, how did they do that? Well, one of the ways was, in fact, to go global. And to do that, however, you had to set up a financial system that could shift money around the world with relative fluidity and relative ease. And again, the literature back in the 1970s is really very interesting. When you're reading it about financial services in the 1970s, people were talking about something called financial repression. Finance was so regulated, and it was so, interstate banking was banned in this country, at that time. And the banking structure, so everybody's kind of saying there's something really wrong with the financial structure. Not only can't we move, is it difficult to move money around within the United States, it's difficult to move it around internationally. So you start to get a huge kind of push to reform and deregulate the financial system, which begins to set in during the sort of 1970s, and it continues up until the point of about the mid-1980s with the unification of the global stock markets in what's called the Big Bang in 1986. So you liberate the financial institutions because you need them to be able to sort of shoot the money around the world. And the result was the financial institutions connived at the deindustrialization of the United States. I mean, all that deindustrialization that occurred in the 1980s, with so on, Well, it was facilitated by Wall Street and facilitated by the financial institutions. And of course, as they're liberated, they get a great deal of possibility, and they can start to invent things and innovate and all this kind of stuff. And so we get to the point where infectious greed and you know, irrational exuberance, as Alan Greenspan called it, sort of take over the whole kind of financial system. And that actually then is the core of one of the big problems that started to emerge in the late 1990s into today. So we got out. One of the ways, one of the revisions of the whole structure of how global capitalism was working required liberating finance to the point where finance could become hegemonic, dominant, and ultra greedy as well, and no question about it. What this also was associated with was the breaking down of nation-state barriers. What globalization did, of course, was to break down trading barriers so that you could start to talk about the global car and the global television set and all those kinds of things. And along with that, there came sort of other innovations like containerization and so on, which allowed movement of goods and services around the world much more easily. So this is, if you like, another aspect of the reform. So labour is weakened by the fact that its protective cocoon of the nation state is no longer able to protect it. It can't assemble power inside of that as easily, and it cannot exercise influence upon the social wage in the same way that it once did. Now, on top of that, you then have the direct assault upon labour. So you invented people like Margaret Thatcher and Ronald Reagan and General Pinochet and the Argentinian generals and all the rest of it to absolutely sock it to labour and destroy all the labour institutions which are likely to protect the social wage. So in effect, what happened was a crisis that was focused on the capital-labour relation because labour was too strong was resolved by the time you get to about 1980, by the fact that capital had access to all of the global labour reserves wherever it wanted to go. It could move around at ease, do what it wanted, and in effect you move from a situation where labour was probably too empowered for the good health of capitalism in 1960s, early 70s, to the point where labour is unempowered, and in fact capital is too empowered right now relative to labour. Now, what this does is to say that nobody in this crisis, as far as I know, has actually said, well, the problem is greedy unions. You know, I mean, nobody's saying that. But that was the chorus that was there in the 1970s. You know, so you know, if you like, the dynamics of the thing have changed, but you can see how this crisis is flowing out of the other one. Now, the result of this was you've got something in the 1970s onwards which is called wage repression. Wages are pretty stagnant because capital can hold them pretty stagnant. It has high unemployment, Reagan recession, 10% unemployment, same bit in Britain and much of Europe. So wages are pretty stagnant and there's no increase in wages. The result of that is that the share of wages in national income is declining. And it's declining in all of the advanced capitalist countries, and interestingly the data on China show it was been declining in China since 1980 or so. So labour has less and less money. And then the big issue arises, well, how, you know, who's going to buy the product if labour doesn't, you know, if labour doesn't have it? Well, the answer was, well, the financial system can assist them by letting them go into debt, encourage them to go into debt. And of course, what we then saw was a huge increase in household indebtedness, a tripling of household indebtedness from 1980 to around now. And you dealt with the problem of effective demand in the market by kind of saying that the gap between what labour's getting and what it can purchase is going to be covered by increasing resort to credit financing of consumption. But if you've got two graphs, one is flat and the other's going like this, at some point or other the tension between them gets too great and it pops, you know. So, and that of course is one of the things that's hit right now. So there's a big problem of keeping demand going. Now, the theory has always been that capitalists, when they're given money, a lot of money, as they were given under the Reagan tax reform and all the rest of it, and as they got out of the fact that labour was in a repressed condition, the capitalists would invest. But invest in what? Again, the question here is not investing in something socially useful, it's investing in something that's profitable. So where were the profits to be had? Well, initially, yes, they could be had in production because wages were low. But a lot of money starts pouring into production, and after a while, competition starts to become significant, because you've also broken down nation-state barriers not only to financial flows, but also to international competition. So you move from a situation of monopoly power in the 1960s, and there are books being written about monopoly capital in the 1960s. The official thesis of the French Communist Party was about we were in a stage of state monopoly capitalism in the 1960s. And this then is broken, however, by a much more competitive environment in the 1970s. Money is pouring in and things get very competitive. So what looked like a sort of oligopolistic situation in Detroit in the American auto industry, by the time you get to the 1980s, is a highly competitive situation. We've got the Japanese and the German car companies coming in, competing with Detroit, and then later on, of course, the Korean, and now the Chinese are coming in. I mean, it's just kind of, you know, so you get a highly competitive economy, and competition often leads to price reductions. And price reductions mean profit margins go down. And the result is, the 1980s, you get a very peculiar economy. You get a low-wage, low-profit economy. And it's at that point capitalists say, why would I go invest in production when I can only get 3 or 4% rate of return? I want something more, you know, lucrative than that, and that's where the asset markets come in. And they don't necessarily invest in production at all, and that's where you start to get all of the asset bubbles sort of coming in that I mentioned earlier, with all of the impacts they've had on the economy. So again, what we find is a trend here, which is an interesting trend in that the way we came out of the crisis in the 1970s defined how we were going to get into this one we're in right now. And then the big question arises, well, how are we going to get out of this one? And there are two sorts of issues here. First is, how are we going to get out of it if there is no macro protest? Well, one of the things that's happened, of course, is that the banks have been bailed out. Now, this is actually exactly what has been happening all along. In the Mexican debt crisis of 1982, Mexico was about to go bankrupt. If they had gone bankrupt, they would have defaulted on their debts, and their debts were held by the New York investment banks. In other words, if Mexico had declared bankruptcy, the New York investment banks would have gone under. And the United States had to rescue the New York investment banks. So what it did was it went to Mexico and it said all kinds of things, you know, to the bourgeoisie down there, don't dare do this, don't go bankrupt, we'll bail you out. And they put together the IMF and the Treasury, and they bailed out the government of Mexico, on condition that the government of Mexico recouped it all by austerity. And the living standards of people in Mexico, which is not a very rich country after all, went down by about 25% in the following 5 to 8 years. This was a standard procedure of an International Monetary Fund structural adjustment program. You bail out the banks and sock it to the people. Now, what have we done? We bailed out the banks, right? And everywhere the banks have been bailed out, now we're saying, oh, but the result of that is we've got all of these huge deficits. How are we going to pay off these deficits? Austerity. Hey, it's sock it to the people time. And that's what the British are doing, that's what the Germans are doing, that's what the Republicans want to do here. In other words, this is a repeat of the neoliberal trick of what was done, and actually, you know, it's very interesting being in Latin America. I mean, I have some very good friends in Brazil and Argentina, and they're kind of laughing and saying, ha, you know, you guys are going through a structural adjustment program without the IMF. And isn't it nice? Now you know what it's like, you know. Now, yeah, we've been through 5 of them in the last 20 years, so, you know, I mean, ha. Isn't it great to watch you squirm, you know? But that, in effect, is what's happening. And this says that the plan as it is at the moment is indeed to reconstitute the neoliberal game. And the neoliberal game was always about protecting financial institutions at the expense of the people.